Good day, good morning, ladies and gentlemen. Welcome back once again to another trading activity walkthrough here at IslandMint. So pleased and so happy to have you join me once again as we continue to offer you insight, offer you great opportunity to go into the thinking and thought processes behind taking advantage of market opportunities as we seek all to create the sort of life and live the lifestyle that we aim and aspire to. So let's just jump right into it. We're pretty light on the trades this week, only because the market saw a lot of consolidation, and so I didn't feel it was appropriate to force too many things. Um, it is very important, especially as a retail trader, to understand that you do not have to be in the market every day. You do not have to place a trade every day in order to be successful. We all should have a plan. We all should have a goal. We all should have a figure in our minds, whether we've set it on a weekly, a bi-weekly, or a monthly basis, to which we aspire to make based on our understanding of, generally speaking, how much our trades have offered to us in the past by way of profit. So coming into this week, I was playing a bit of defense because after having had a fairly big run up in the market in the past 3 weeks, and I'm going to give you a clear idea as to what I'm talking about here. If we flip over quickly to the S&P index, you can see, and this is a 20-day 1-hour chart. In this entire time frame, the market has done practically nothing but go straight up. And this, of course, to put some greater context, is taking place after the large drop that we saw last quarter, accelerating into a bit of capitulation coming into December. As you can see, starting here in about October, we had a very deep sell-off entering bear market territory when the market is down 20% plus from its highs. So we've had a sharp sell-off coming out of December and a recovery starting in the last week of December. And so from the last week of December, first week in January, second week in January, third week in January, fourth week in January, we've done practically nothing but go straight up. And at this point, we've recovered. Let's draw a quick Fibonacci ratio so you can see exactly what I'm referring to. Fib retracement. So we'll just start at the highs here, go down to these lows. And so you can see from the lows, we are just hovering around the 50% retracement level. Almost seem to wanting to try to test the underneath of this 61.8 area. But so far, we've fairly handily, easily reclaimed this 50% retracement area. And so what this means is we've basically, in layman's speak, recovered half of the losses that we encountered in that fourth quarter sell-off. And so coming into this week, I know we're coming into some overhead resistance, and so I was in a fairly cautious mindset in terms of how would I approach my trading going forward this week. And so coming in from last week, as you would know from last week's video, I had a trade in Tesla still on, and I was looking to target Johnson & Johnson going into this week. And so Tesla was the first, Johnson & Johnson, forgive me, was the first trade that I put on. And let's just give you an overall context here. So this is a 2-year weekly chart. And so you can see Johnson & Johnson has been consolidating, roughly speaking, within this nice little uptrend line here. You can see down at the bottom that I have drawn here. It has an absolute high of around 149. And what it's been doing is every time it's come up to test this range, it has been pretty quickly rejected the ascending trend line has served as pretty consistent support thus far. It has retested the top of the range and again back to test the bottom of the range. And so if Johnson & Johnson is going to hold this familiar pattern that it has had for the last 2 years, then if we are looking to get long, if we are looking to buy the stock in order to see some price appreciation, this area around the ascending trend support line is a good, from a probability perspective, it's a good risk to reward ratio, because all we would be risking is when we get long inside of this region here, we can put our stops beneath the ascending trend line, because we know that if it breaks, then this context of its most recent range for the past 2 years is no longer valid. And so I was looking at Johnson & Johnson coming into this week in a defensive mind frame, but still looking to take advantage of any moves that might present themselves. So on the shorter time frame here, this is the 20-day 1-hour chart. You can see that Johnson & Johnson has had one peak beneath the range, has had probably 2 attempts, just this one right here at around 130. And then most recently, the day before its earnings report, attempted a breakout of its recent range high at around 130.50. That did not hold much. It announced its earnings. It had a slight beat, but a bit of downward guidance. And you see this big indecisive candle here, testing the top of the range just above 129, and then going down to test the low of the range at around 126.90. So because of the demand that I saw for Johnson & Johnson earlier on in the week, and I like this nice tight consolidation between 127 and 129, I was simply looking for a play where I would get long near the bottom of the range around 127, and then I would play for a retest if that's what the stock wanted to do, to break out above and through 129 and 130. And so the first trade that I placed in Johnson & Johnson actually was on its day of earnings. I will zoom into that for you on a 15-minute chart so you can see it better. So this is his earnings day right here. And as Johnson & Johnson broke down into this 127 area, I got long the 129 calls. I got long the 129 calls 2 weeks out. So I think I would have had something around 10 days to expiration at this point. And it bounced around for a bit, and then began to make some gains as it headed up into 128. However, because I had so much time to expiration, I think I was probably up close to $250 at this point on the trade. But because I had some cushion of the trade already and I had a lot of time to expiration, I held, anticipating that Johnson & Johnson in the next day or next few days would at least attempt to break out of this most recent range high at around 129. And so what happened on Wednesday, I had this little trend line drawn. It bounced around, seemed to test, come back down, bounced around, no real progress. And again, this was also reminiscent of what was going on in the wider market, because there was a lot of consolidation going on, no moves to the upside, no moves to the downside, and or those moves being quickly reversed. So price would come up to test the top of its range and then would be rejected and go quickly down to test the bottom of its range and be rejected there and turn up. So it was a range bound market. And so Johnson & Johnson, from what I've observed, is also a very, how should we say, wider market influence stock. Very rarely do you find it has strength in and of its own. It usually goes with what the other stocks in this particular sector are doing. So healthcare stocks and or the wider market. And so on Thursday, Johnson & Johnson opened very weak, came down to test the bottom of this most recent range, broke, rallied back up a bit just to give some early bears who may have been premature shorting at this level a bit of a scare. They got out and then ran it right back down into a former low at around 126. I actually got long another set of Johnson & Johnson calls because I anticipated that, all right, okay, it breaks this most recent range that was holding between 128 and 129. The next low was 127. And so I took a chance to go long calls on this little consolidation here when it was holding 127, anticipating that we would get a bounce. That did not materialize. And so I sold out of those calls for around an $80 loss, which I would consider a good trade because very easily I could have been down at this point here a couple of $100 for no necessary reason when I could just take the loss and revisit the context and the hypothesis that I initially got into the stock for. And as stocks are wont to do, of course, on Friday, it opened weak in tune with the wider market, which also opened on a high. So it gapped up, but then sold off as the wider market sold off as well, but rebounded and then just continued to hold the bottom of this range that it established for the last several weeks or so. And so I don't think Johnson & Johnson is finished. However, I will have to be a bit more nimble on this one, that if indeed it does not want to break down or above its range, I will have to revisit my my idea for trading it, because it now means that I will have to take quick profits. So instead of waiting for a longer hold, anticipating a trending movement up and out of this range, or going short and anticipating a breakdown down and out of this range, I will simply have to buy at the lows, sell at the highs, sell at the highs, buy at the lows. And so that's Johnson & Johnson as it looks right now, and as I can surmise, it's just simply caught in a range, and any trading that should be done in there will have to be quick, nimble, and or for time decay, selling premium on both sides. Selling premium on both sides of the range via something like covered calls and or an iron condor. And then let's take a quick look at Tesla. I only had trades in 2 tickers this week. Like I said, this is going to be short and sweet for you guys. And so last Friday, Tesla opened down after a news announcement pertaining to them laying off many staff and things of that nature. And so Tesla opened down weak. I went long, I believe, at around, I went long around this area, this 315 area. It broke down, and I sold out for a loss at this point in one position. But I rolled one contract to this week's expiration, anticipating that perhaps it would either stabilize and or make even a slight recovery that would allow me to recoup some of my losses in this big flush that they had coming down here. And so I had that trade on all week. I saw Tesla sort of weaken and sort of hold its ground and show some signs of consolidation, which is what you want to see. When something has such a drastic fall, you want to see momentum slow down before you can begin making a decision, because otherwise you're simply taking a guess. Now, there's nothing wrong with taking a guess. You just have to position size appropriately so that if you are indeed wrong, you're on the wrong side of the call, you are comfortable with the loss that you will sustain, and or you are able to maneuver and trade around that core position. And so on Wednesday, Tesla again opened down with the market, traded down to a new low of around 279, and then popped back up nicely and began trending out for the first time, trending out of this range that it has held for the past day and a half or so, which is very good to see. And so what I took that as the opportunity to do, I rolled my position. I had a 312 and a half, 305 put spread, short put spread. So I was short and in the money put. And so the only way to have that position appreciate would be if the price goes up towards my short strike, which is around here at around 312. But because it was so late in the week, what I did was I took some of the credit that I originally paid for, I originally received from the first trade, and established a new trade at the 285 level. And so I actually had two contracts of the 285, 277 and a half short put spread, which means that if Tesla expired at or above 285 for the week, I would keep the entire credit that I received, which was at around, I believe, just shy of $600. However, as Tesla moved up aggressively, and on a Thursday, I actually had an automated order put into the system to close that position at when it reached $1 remaining of credit remaining. And I did that simply as a precaution in the event that the stock began to move fairly quickly. I did not have to go through the manual process of putting in an order and adjusting it. And so I had that there almost as a placeholder. I didn't anticipate or actually desire at that time to execute the order at $1. However, these are some just of the nuances and idiosyncrasies that come into your trading process at times, that you have to be aware and focused as to what is going on in the market, especially with positions that you have that you're actively trading. And so I had the order in there, anticipating that as it continued to move up, I would continue to adjust my order downwards, and so that I would retain more of the credit. But it spiked on this spike here. I was actually stopped out for the $1 credit that I put in there automatically that I could not change before it spiked. And so I stopped out of the trade, I believe, for a profit of around just shy of 350, I suppose. So a bit over 60 to 70% of the original credit that I received, which in and of itself was not a bad trade. And so I was fairly pleased by that, but a bit miffed that I missed an additional $200. If I had just been a bit more nimble to either adjust the order downwards and or wait, because Tesla did come back in on Friday. It tested to as low as 289, but never threatened this 285 level. So I could have indeed kept it on the entire day on Friday as well and received the entire credit. But then again, we just sometimes never know. And so you have to go with your honed instinct over time to trust whether you should take the profit that you're given that day and roll it into something else, and or take the risk to hold it overnight. And anything can happen. Something that could be negatively affect the stock price, and then you're scrambling the next morning to try to get out of the position. And so I didn't do that, but that's something that you're going to have to learn through and in time as a trader, to trust your instinct and or develop a robust process of decision making as to how you go about choosing whether to hold a winning position overnight into this last day of expiration. I believe many seasoned traders will tell you that if you have gotten, let's say, 70 to 80% of the credit already, then perhaps it's not worth it to trade that 80% that you've already gained into the trade for the possible 20% that may remain, and or lose all of that 80% and much more if, for example, something was to happen overnight that would cause the stock to go down, and then your unrealized profit would evaporate at that point. So that's it, guys. That's my 2 trades for the week. A couple trades in Johnson & Johnson and just this 1 trade in Tesla. And so I'm going to be keeping an eye on Tesla going forward, in particular because I do believe that it is going to continue to rally. But the caveat is that Tesla has earnings coming up this week on January 30th. And so any trade that I make around Tesla, I must be aware of that because I'm not going to hold that trade going into earnings. Today is Monday morning on January the 28th. And so I literally only would have 2 days to do any sort of trade in Tesla, whether to go short or to go long, which I'm not quite comfortable with just yet. And so I may have to look for another opportunity, another stock to give me an opportunity to sort of meet the risk criteria that I'm comfortable with for such a short duration. I want to thank you guys again for joining me. Please, if you have any questions, any tips, insights, and advice, or things that you would like to have covered in these trading activity walkthroughs, please feel free to drop me a comment in any one of my posts. You can follow me on Twitter, send me a tweet, direct message me, contact me on LinkedIn. I'm happy to chat, always happy to have a conversation with anyone who has an open mind and is willing to learn and to share the knowledge that they have gained also, whether in or out of the markets, because at the end of the day, we're all here to help each other, to learn, to grow, to excel, and to be the best that we can be. So once again, as in trading, so too in life. Sophistication in thought, simplicity in execution. Thank you guys. Have a nice day.